Most people are basically winding down, of course, because they've had either a very good year or they've survived after a bad start of the year. And so the tendency is to actually withdraw liquidity, and you see that. The market's getting quite skittish. The volumes are way down from just a month ago. I expect we'll see a lot of renewed activity in the next quarter coming up. And we could actually see much stronger markets temporarily, but as we've seen for the last 3 months, there are spurts of liquidity, and then people step back and say, oh, well, maybe there's this problem. There's always the balance between inflation, deflation, slowing growth, excessive growth. No one really knows. So it's a typical bottom of the market, top of the market uncertainty. Unfortunately, most of the money we're dealing with right now is from the government. The private sector has not been a major provider for quite a while. And the banking sector, which drove things off the cliff a couple of years ago, has also been more or less on the sidelines. It's easier to get leverage right now than it was 6 months ago, which has helped the markets a bit. But again, as we know, leverage is not return, or it's not profit, it's just short-term return, it's trading opportunity. So the markets have been doing well in the broking sector, but the portfolio sector has not really done much of anything in the last quarter. Even the hedge funds are having some difficulty because the usual indicators where they make money are now in reverse, and a lot of the correlations are screwing up all over the place. We've got steep yield curves all over the world, and nonetheless we have a high cost of access to credit for most everybody. A bit of a conundrum right now.
Conundrum indeed. As we look to 2010, we have these warnings of asset bubbles, of bubbles bursting. Most recently in December, the Monetary Authority here in Hong Kong warning of this. We have economists concerned about China. How much stock do you place in this theory of asset bubbles in Hong Kong, in China?
Well, bubble is like the end of the growth cycle, are pretty loose terms used by people in a fashion cycle, I think. I'm more of a fan of the PBOC, and they're a little more conservative about things. If you recall, they were warning us in July of this year that things had gotten out of hand. There was too much liquidity sloshing around. Credit demand was being swamped by credit supply, et cetera, et cetera. They've been put back in the box for a while, but more or less now they're coming out and they're doing soft tightening in the market bit by bit. We've heard the new supply of credit from the CBRC has been off quite a bit from the last quarter. Hong Kong, in that sense, is just talking the party line. To be quite frank, although there are a number of intelligent people in the government right now, for the most part they work for Beijing. And I think a lot of what they say reflects Beijing's concerns about Hong Kong being a speculative center for liquidity. Now, as you know, Hong Kong is the process of moving from being a single currency society to being a dual currency society. That's part of the long plan. The renminbi and the Hong Kong dollar will coexist, or the pseudo dollar will coexist. And at some point in the future, 5 or 10 years from now, one currency will drop away. Obviously, the Hong Kong dollar will repeg itself, or the renminbi will be the currency. But that's not something today. It's going to happen. But nonetheless, it means that Beijing is much more sensitive about how Hong Kong handles liquidity because it's dealing with their currency, not the US dollar anymore.
Beijing obviously very sensitive to what the international community is saying about its currency. What kind of moves, if any, can we expect in the Chinese yuan next year?
Well, there's a good chance there may be some face-saving or face-granting accommodation. But I think my opinion is that Beijing is really, not Beijing per se, but the Chinese economy as a whole is in a very fragile state right now. Much of the world is, of course, but the OECD economy is the big problem. But of the developing world, China is actually in a quite fragile state because it has been for the last decade in a big shift toward social transformation, which was driven by high FDI numbers, high credit expansion. And at the same time, they've been trying to impose discipline in the markets by making mutual funds work, for example, or making the stock market work in a more less volatile section. But the speculation on China growth has led to huge influx of capital, which has caused great headaches for them. But now, all of a sudden, their major trading partner has become a handicap, and their second major trading partner, Japan, is also having difficulties. So it's difficult to sustain the kind of growth which they need to make society work with that kind of external environment. And they've been very aggressive in pumping the market up, but they will pay for this again. So they're in a position where they cannot accommodate outsiders who say, you're stealing our jobs. They say, well, we need jobs first. Now, who cares? You accepted our exports 10 years ago, 5 years ago, 1 year ago. What's wrong today? I mean, this is the debate we're going on now. So it leads to tears, I'm afraid. And China is highly at risk. I think more the risk is the currency will probably continue to, on an effective basis, depreciate if you adjust for tariffs, taxes, and subsidies, rather than appreciate.